Hi, welcome back. I didn't plan to do this session, but I've been reading a lot about equity risk premiums. As those of you who've been reading my posts or watching my YouTube videos for a while know, I'm a little obsessed with equity risk premiums. I've written about them at the start of every month for the S&P 500. I compute the equity risk premium. I do it for myself because I need that number to value companies, and I'll come back to that in a moment. But I also share it on my website for people to use. Now, I don't blame you though if you're a little confused about what an equity risk premium is. What are we trying to measure? Because there's a lot of smoke out there. What adds to the confusion, however, is the fact that if you've been reading the press, you notice that there are a lot of different numbers floating around, all claiming to be the equity risk premium. Now, when I did my most recent, in the start of July 1st of 2023, when I estimated the equity risk premium, I estimated to be about 5% for the S&P 500. And just in the last few weeks, as I've been perusing the press, I've noticed multiple values for the equity risk premium very different from mine. For instance, just last week, I think there was a Wall Street Journal article that talked about how equity risk premiums had dropped to a 20-year low. Right, 1.1%. There was a Reuters report that put it at 2.2%. There's a well-known bearish, he's been bearish for a long time, money manager who claims it's actually negative, that the equity risk premium is minus 7%. And and if you're wondering, how can you have a number, an equity risk premium concept where there is so much divergence in the numbers? Now, the objective of this session is not to convince you that my number, 5%, is right and these other people are wrong, but to give you a sense of why there are differences, how there are different ways of estimating risk premiums, and how you can decide which one works for you. So let's step back. Let's think about what an equity risk premium is. I don't want to be pedantic, but I want to start with basics. When you invest in an asset, if it has risk, you're not going to settle for a risk-free rate on that asset. Why? Because as investors, we're risk averse. What does that mean? To invest in a risky asset, you've got to offer me a carrot, something over and above the risk-free rate, a risk premium. I'm not calling on elaborate economics here, just common sense. Risky assets, you need a risk premium. That's a price of risk. That's what you have to pay me for me to take on risk. Now, that price of risk can take on different names in different asset classes, but every single risky asset class, there is a risk premium. Let's start with the bond market. In the bond market, when you buy a bond with default risk, because in a bond, remember, you're promised coupon payments and face value. The risk you face is that you will not get paid. The more default risk there is in a bond, the higher the interest rate you charge on the bond. That difference between the interest rate you pay on the bond and the risk-free rate is a default spread. So in the bond market, it's a default spread that measures the risk premium. What about in real estate? If you've been involved in real estate, you know the number that's used to value real estate properties is a number called the capitalization rate. What does that mean? It's a number used to convert income on a property into a value for the property. I'll give you an example. Let's suppose you have a property with $1 million in rental income and you want to convert that to a value. Let's say the capitalization rate is 8%. With $1 million in income and an 8% capitalization rate, the value for the property will be $12.5 million. The 8% becomes the denominator, the factor that you use to convert income to a value. Think of it as an expected return on equities. If you net out the risk-free rate from that, there's a risk premium in the real estate market, and it's captured in the capitalization rate. Riskier real estate properties should have higher cap rates. Riskier bonds should have higher default spreads. Let's get to equity risk premiums. Let's say you're thinking about investing money in equities collectively. The equity risk premium is the price of risk in the equity market, the additional return you will expect to make over and above the risk-free rate to invest in stocks. Remember, the fact that you expect to make a risk premium doesn't mean you'll always get a risk premium. The essence of expectations with a risky asset is sometimes the actual returns can disappoint. They could be less than the risk-free rate. But at least going in, you expect to earn a return higher than the risk-free rate. That's what risk premiums are. And the equity risk premium is the price of risk in the equity market. So you see what goes into it? Everything. You say, what do you mean everything? Remember, this is the price of risk in equity market. So everything happening in the market, in the economy, is going to play out in that rate. I've listed 8 components here that can drive the equity risk premium, and there are probably some that I'm missing. The first is the risk aversion of the investors in the market. As investors get more risk averse, they're going to demand higher risk premiums to cover that risk aversion. You're saying, well, what drives risk aversion? Well, one factor we know drives risk aversion is age. Older investors tend to be more risk averse than younger investors. So what's the implication? As investors in a market, in an economy age, you should see equity risk premiums rise in that market. So maybe European and Japanese equity risk premiums are going to get higher over time because of the aging. And if you believe the demographics that are projected for China, there are higher risk premiums in the future for China. The second factor that drives equity risk premiums is the amount of uncertainty you feel about the economy. So the more uncertainty you feel about the future of the economy, the higher equity risk premium should be. So the implications, if you're in a younger, growing economy, there should be a lot more uncertainty about the future than if you're in a more mature economy. In my last session, I talked about country risk premiums, how risk premiums are higher in some countries than others. This may explain part of it. The second is even in the same economy, the amount of uncertainty varies over time. The essence to me of a crisis, you're facing a period of intense uncertainty in a market. So in the first quarter of 2020, when COVID hit, remember what happened? You were uncertain about what the economy would do in the future. Equity risk premium shot up. The third factor driving equity risk premiums is inflation. High inflation by itself is not an issue, but high inflation often comes with uncertainty about inflation. As that uncertainty increases, equity risk premiums go up. So other things remaining equal, you'd expect equity risk premiums to be higher in high inflation environments than lower ones. That might explain the rise in risk premiums in 2022. Information disclosure plays a part because after all, as an investor in equities, you can only use the information companies provide you to make judgments on companies. The more complete and transparent that disclosure, the better you feel about your investment. So the implication is in economies and markets where information disclosure is flawed, it's opaque, you should expect to see a higher equity risk premiums. Liquidity and fund flows clearly matter. If there is lots of liquidity and funds are flowing into equities, equity risk premiums should decrease. Anything that stymies those flows, whether it's regulatory, whether it's a crisis, will cause equity risk premiums to rise. Then there's the notion of catastrophic risk. What is catastrophic risk? It's the kind of risk you and I don't want to see in our lifetimes. It's a low probability event that has huge consequences. It could be a pandemic. It could be a nuclear war. Now you're saying that won't happen in my lifetime? Probably not. Let's hope not. But the probability of that happening always has to be considered when you value equities. So if that probability shifts even by a small bit, you should see equity risk premiums rise. Can governments affect equity risk premiums? Absolutely. If you have a government that's capricious, that changes policies and rules and regulations constantly, you should see higher equity risk premiums than if you have a government that's more predictable in terms of its policy. So equity risk premiums should be greater in countries where there is more discontinuity in economic policy, more change in rules and regulations over time. And finally, central banks and monetary policy have an effect on equity risk premiums, perhaps not as great as some people attribute to central banks, but they do. Central banks that are less predictable in their reaction to events, in their actions, more inconsistent in their actions, will end up creating higher equity risk premiums. You could argue that across the world, central banks have become more active and less predictable, and that might be contributing to the rise in equity risk premiums globally. So all those things play out in that one number. Now that said, you're saying, what about mood and momentum? They play a role as well. In fact, the equity risk premium is in a sense is the receptacle for all your hopes and fears. When people become over optimistic about the future, irrationally exuberant, in Alan Greenspan's words, you're going to see equity risk premiums get too low. People are pushing up the prices of equities to a point where they're earning too low a premium. My definition of a bubble is when you price stocks to earn a risk premium that's completely disconnected with fundamentals. Now, you might say, well, I've never used equity risk premium. I've been investing for 40 years. Why should you care? You know what? You might have never used those words, but no matter what type of role you played in markets, equity risk premiums have been at the basis for what you do. Let's take a few examples. Let's say you're one of those people who tries to time markets. I'm not, but there are a lot of people who do. I'm going to argue that every statement you make about the market is actually a statement about equity risk premiums. So for instance, when you tell me stocks are overpriced, you're telling me the equity risk premium has become too low relative to what you think it should be given the fundamentals. If you're bullish on stocks and I think the market's going to go up, you're saying the equity risk premium is too high and it has to come down. So I'm sorry, it's too high for whatever reason. People have become too panicked. It's got to come down. So every market timing action is actually about equity risk premiums and where you think they should be relative to where they are today. If you're a stock picker, you're saying, I don't care about the market, right? You do. And here's why. To pick a stock as an investor, you got to value the stock. To value the stock, you need cash flows and growth, and we can agree and disagree on those numbers. But you also need a rate of return you will demand for investing in that stock. You can't pluck that number out of thin air. That number is going to be a function of the equity risk premium. So if you say, I've always used 10% as my cost of equity, you've been using a time-varying equity risk premium without ever using those words. Why? To get to 10%, if the risk-free rate is 3%, you added another 7%. You stayed with that 10% when risk-free rates went to 7%. You said, I'll settle for a 3% risk premium. The risk premium becomes an input that determines the discount rate you demand in valuation, so it clearly has an effect on value. That's why I need equity risk premiums, because I believe in value, and to value companies, I need a measure of what the market is charging for risk, that price of risk in markets. You're saying, what if I work in a company? I'm a CFO. Why should I care about equity risk premiums? The same forces that make the equity risk premium play into your required return for equity as an investor become factors that drive your cost of equity as a company. Last year, as both risk-free rates and equity risk premiums rose dramatically, the cost of capital and cost of equity for a typical company increased by more than any single year in history. So if you're a company, that becomes a hurdle rate. It determines whether you can invest or not, whether you should pay dividends or not. So no matter what you do, whether it's in corporate finance, in stock picking, in market timing, even if you've never used the words equity risk premium, they've played a role in your actions, which means that you have no choice. You have to make a judgment on equity risk premiums or it'll get made for you. And here's the problem we face. In the bond market, we can observe default spreads. Why? Because you can see the interest rate in a bond. So if I think a bond has high default risk, I push up the interest rate, you can observe the default spread. When equity investors get scared and they push up the price of risk in equity markets, the equity risk premium, it's not observable. So the question is, how do we then estimate equity risk premiums? I'll take you through 4 approaches that can be used that can yield 4 very different results. And I'll give you the pluses and minuses of each. The first is a historical risk premium. What do? Even though you might not be able to observe what people are expecting in the future, you can see what they've made in the past. On stocks as opposed to something riskless. In the US, you have a lot of historical data that you can base it on. The second is to use historical returns, but rather than just use the average, see if there's a time pattern that you can use to forecast expected returns. The third is, and this is actually more widely used than it should be, is to look at the inverse of the PE ratio. So if your PE ratio is 20, the inverse is basically 5%, 1 over 20. It's called the earnings yield. It's earnings to price ratios. There are a lot of people who use it as their proxy for the cost of equity. I'm going to talk about the limitations of doing that, but there are a lot of people who use that to come up with an equity risk premium. And the final approach is you expand on that earnings yield approach and say, look, I buy stocks not for earnings last year, but for earnings in the future. And those earnings could be higher, and I could make more than my cost of equity. And I'm going to try to figure out, based on what people are paying for stocks, what they're expecting to earn as a return, an internal rate of return on stocks. So let's start with historical equity risk premiums. the US market, you got historical data going back to 1871. But the most reliable historical data is from the 1920s. That database has been mined and reused and used and to the point of diminishing returns. But what I've done here is gone all the way back to 1928 and computed historical risk premiums. And here's what I'm doing. I'm looking at the returns you could have made on stocks, the returns on T-bonds and the returns on T-bills over different time periods. So if you go back to 1928, you can see that the returns I could have made on stocks on an annual basis would have been about, on an arithmetic average basis, if you take the average return, about 8.19% higher than T-bills and 6.64% higher than T-bonds. You say, that's pretty impressive. Well, it's been a pretty impressive century for US equities, primarily the 20th century, but pretty impressive overall. If you go back 50 years, the premium is smaller. It's different and it's smaller because you're using a different time period. It's 7.33% for T-bills and 5.14% for T-bonds, but still good. If you go back 20 years, the premium zooms again, or 10 years. So basically you can see that that when you talk about historical premiums, the number you get can vary depending on the slice of history you look at. It can vary on what you define as riskless. Is it short-term treasuries, T-bills, or long-term treasuries, T-bonds? I'm using 3-month T-bills and 10-year T-bonds here because those have the longest history. If you look just at the last year, you felt the pain, right? If you were an investor last year, stocks were down. And what made last year such a horrifically bad year for investors is stocks were down about 18%. And T-bonds, that haven of safety, were also down 18%. So if you look at the equity risk premiums, the difference is what you'd have made on stocks versus bonds. Last year's equity risk premium was minus 20%. Of course, it'd be absurd to take last year's number and make that your expected premium. But you can already see, just looking at this table, how there's an element of judgment involved here. And in every one of these, you're looking backwards to get a sense of what that risk premium should be. This remains the default approach that appraisers and analysts use to get risk premiums. And I've struggled with why people are so stuck with this approach. And there are two reasons, I think, that attract them to historical premiums. The first is that historical risk premium is a stable number, and there's a simple mathematical reason for it. If I look at the risk premium from 1928 to 2022, no matter how good or bad 2023 is, by itself, that number can't shift the premium too much because it's one additional year on a long tail of history. People like stability, even though stability might be the last thing you should be expecting in an equity risk premium. The second is this false precision you get. I have an equity risk premium. That average is somehow a fact. Let's take an example. If you look at the equity risk premium on an arithmetic average basis, stocks versus T-bonds, going back to 1928, you get 6.64%, second decimal point. But before you get too impressed, let me go back to the previous page and draw your attention to a number. It's called the standard error. What is that? Statistically, it tells you that there's a range around your average. And if you add plus or minus 2 standard errors, that's a pretty standard approach to getting 95% confidence. Even with a 94-year time period, my equity risk premium is not a fact, it's a range. It's between 2.34% and 10.94%. Think about that. With 94 years of history, if you ask me what's the equity risk premium for the US, I said somewhere between 2.3 and 11%. It gets far worse if I go to 50 or 10 years. Already you can see that this notion that equity risk premium is stable and precise is delusional, but people hold on to it. The second is bias. Now, I've often talked about how appraisers and analysts like to give off this illusion that they're objective and scientific, but the reality is they have agendas. I'm not meaning that in a bad way. It's, you want to either come up with a higher or lower number for whatever reason. The nice thing about historical risk premiums, you get your pick of what you can use as an equity risk premium. If you go back to the previous page, look at the range, 4.12 to 13% at the high. If you're an analyst who wants to come up with a really low value for your company, you know what you're going to do? You're going to use the 13% risk premium. You want to come up with a high number? Use the 4%. So This might be the default, but it comes with significant limitations. And I want to draw your attention to what you're implicitly assuming when you use historical risk premiums. The first is you're assuming mean reversion. That's just a fancy way of saying things revert back to the way they used to be. You're saying, what's wrong with that? We've done that. That's what we do in valuation investing all the time. You're right. And we become too used to doing it. Because when you use mean reversion, you're also assuming that the underlying structure, remember those fundamentals we talked about, the drive risk premiums, are not changing systematically over time. You know why this historical equity risk premium approach has such deep roots? Because in the 20th century, in the US, which is where a lot of appraisal and valuation had its roots, it worked really well because the US was the most mean reverting predictable economy of all time in the 20th century. But we're not in the 20th century anymore. The world has shifted under us. This is no longer a global economy where the US dominates. The US is the largest economy in the world, but China is catching up. The crisis of 2008 blurred the lines between developed and emerging markets. I'm going to argue that if you had a case for using historical risk premiums pre-2000, it's a weak case. Now it's become non-existent. So that's a historical risk premium. The second approach, you stay with historical returns, but you try to use them to predict an expected return. See, what does that even mean? Let's say there are patterns in history. In other words, if you have 5 good years for stocks, maybe the next 5 years are going to be bad years rather than good years. Then when you make predictions, you don't just look at averages, you look at recent history, you look at what stocks did last year, last 5 years, see if you can make a prediction for the future. When you use this approach, you're effectively assuming that there's correlation across time in returns. I know that sounds like inside statistics, but if returns across times in stocks were uncorrelated, what happens in a year in stocks has nothing to do with what will happen next year, then this approach and the average return approach will give you the same answers. So while I've seen some people use this approach and claim it works, I started by looking at the correlations. I said, is there even a basis for just using stock returns to predict the future? And the answer is, at least in the correlations, is there isn't. Take a look at the correlations between this year's return and the next year's return. It's minus 0.0157. It's negative, but it's so mildly negative that it's basically statistically insignificant. It's zero. It's a little more negative when you get to 5-year returns, but even there it's not statistically significant, and even that mild significance disappears when you look at 10-year returns. There's very little basis in history for arguing that using past stock returns to come up with an expected return in the future is somehow going to give you an equity risk premium that's better than just using averages. But there is a variant of this approach that offers a little more promise. What if you could combine stock returns with some measure of how cheap or expensive stocks are at the start of a period? I'll give you the most widely used approach. You heard the notion that if stocks have low PE ratios, you're in a better position to get higher returns. So here's what I did. I took the inverse of the PE ratio, the earnings to price ratio at the start of every period, and looked to see whether it was correlated with returns in the next year, the next 5 years, the next 10 years. I'll give you the good news. Over 5 or 10-year periods, there is a correlation, and the correlation is positive. When earnings to price ratios are high, in other words, price earnings ratio is low, you can expect to earn higher returns in the future. You've seen variants of this graph from people who use this approach. But basically, this means that if PE ratios are low, earnings to price ratios are high now, you should expect to earn higher returns in the future. If PE ratios are high, earnings to price ratios are low, you should expect to see lower returns in the future. I took the 94 years, in this case, the data from 1960, because I have a lot more confidence in those. And you can see the results, right? And the way to read this is now if you look at the t-statistic reveals that it is significant, that when earnings to price ratios are high, the returns are high. And that I can actually use this regression to make predictions. You're getting excited, right? You're saying this is good. In fact, if you take this regression and plug in the numbers for using today's earnings to price ratio, you get an expected return based on history. And the link between earnings to price ratio and returns of 6.07%. This is a 10-year average annual return. So if you believe this regression, given where we are, you can expect to earn a return of 6.07% a year on stocks. You subtract out the T-bond rate, that gives you an abysmally low equity risk premium, 2.1%. That's going back to 1960. But remember, this is an estimate, it's a prediction, but with regressions, predictions come with errors. Well, basically, it's between 4 to 8%, still low, but it comes with a range. Pushing the data back to 1928 makes the relationship stronger. And actually can, especially with some variance on how the earnings to price ratio, you can end up with expected returns using this approach on stocks that are lower than the risk-free rate. Remember I talked about that bearish money manager who is claiming that the equity risk premium is negative? He uses a variant of this approach. You might have seen some of his graphs, and essentially using the link between earnings to price ratios and 10-year returns to tell us, look, you're going to actually earn an expected return less than the risk-free rate. Your equity risk premium is negative. Now, I know this is data-driven. I know you're a tracker, but there are 3 caveats I would add. I'm not saying you shouldn't use this. The first is the link between earnings to price ratio and returns works only with longer time horizons. So if you use earnings to price ratio in next year's return, there's almost no linkage. You can't use it for predictions. It's next 5 years and next 10 years. You're saying, so what? When you match up earnings to price ratios with returns over the following 10 years, there are 2 statistical issues. The first is you end up counting the same data multiple times in your regression. I'll give you an example. If you use the 1960 earnings to price ratio and you look at it at a 5-year return, you're looking at 1961, 62, 63, 64, and 65, right? Then you go to 1961 earnings to price ratio, you go and you look at the next 5 years, it's 62, 63, 64. You're saying, so what? I'm counting each year 5 times in my regression because it's showing up as one of the years in the 5-year returns for the five prior earnings to price ratios. That doesn't mean you can't run a regression, but it does mean your T statistics and R squareds are overstated. This is the second problem. When I use a 10-year time horizon, my last year for prediction is actually 2012. Because I use the earnings to price ratio in 2012 and I look at the returns from 2013 to 22. You see, why can't I do 2013? Because I don't know what the returns are in 2023. I'm actually losing the last 10 years of data. It's a data problem. The second is, as with the historical risk premium, you are assuming that the structure is not changing, that the underlying fundamentals are not shifting. And I would say the same thing that I said about historical risk premiums. We're not in the 20th century anymore. In fact, I would argue that it's time to let go of the 1928 to 1960 data because it was an uncommon period for US stocks. Finally, many of the pushes I've seen for this approach talk about the R squared. And we're impressed, 70% R squared. Remember, you can't trade R squared. You can have a model with high R squared, but remember that ultimately you make returns on what you buy and sell at. And many of the predictions, even with high R squareds, come with big ranges around them that can often leave you uncertain about what to do. Put differently, converting what you learn from these regressions into action is difficult. Let's go along with that minus 7.25% equity risk premium that you got by going back to 1926 and using the earnings to price ratio. Let's say you believe that. What are you going to do? Does that mean you sell all your stocks today and go into cash? Okay. How long do you wait? Well, until a correction. What if the correction doesn't come for? In other words, how quickly does the correction have to come for this approach to pay off? And if the correction comes, when do you get back in? There are so many unanswered questions here, which might explain why people who've used this approach have essentially stayed out of stocks for much of the last decade. And that wasn't a great place to be as an investor. Which brings me to the third approach, where you look at the earnings to price ratio. Let me give you the basis for the earnings to price ratio being the cost of equity. It goes back to a very simple valuation model, the simplest one that I can think of, a stable growth dividend discount model. Yeah, the value of equity for a mature company that pays dividends is the present value of the expected dividends growing at a constant rate in perpetuity. It's called the Gordon growth model. You take it as the first step in every valuation class. So there's the Gordon growth model. Now here's what I'm going to do. I'm going to make an assumption that there's no growth and all of the earnings get paid out as dividends. The payout ratio is 100%. If I plug in zero growth and a payout ratio of 100%, guess what? The cost of equity does become the earnings to price ratio. So the first scenario where the earnings to price ratio is the cost of equity, we assume no growth and that all of earnings get paid out as dividends. There's a second scenario where you do assume growth, but you assume that to grow, companies have to earn a return that's a return on their equity almost equal to their cost of equity. If you do that, again, and you can work through the algebra, you can use the earnings to price ratio as your proxy for the cost of equity. Remember that Wall Street Journal article that I talked about that found a really low equity risk premium? It used the earnings to price ratio as the cost of equity. Now the problem, of course, here is assuming no growth and assuming companies don't make excess returns is at war with the data. To get a sense of how the earnings to price ratio approach would have been performed in terms of delivering an equity risk premium, here's what I did. I went back on a quarterly basis to the last quarter of 1988, looked at the earnings to price ratio, the green line, and the T-bond rate every period. And I computed the difference between those two because if the earnings to price ratio is the cost of equity, the T-bond rate netted out should have given you. Notice that with this approach, the equity risk premium is actually negative through the 80s and the 90s. If you'd used this approach, you'd have stayed out of stocks for the entire decade of the 1990s. Think about what that would have done to your overall portfolio. In fact, when the Wall Street Journal talked about how this approach yielded the lowest cost of equity in the last 20 years, technically they're right, because the equity risk premium using this approach did surge in this century, primarily because the T-bond rate collapsed. But it's surprising, perhaps it's not so surprising. The Wall Street Journal did start in 2000. If they'd gone back before, they'd have very quickly noticed that it's not the lowest number ever. In fact, there have been periods where this number would have been negative, the earnings price-based equity risk premium. So my problem with the earnings to price being used as the cost of equity is it's clearly at war with the data. The earnings growth for US stocks has never been negative for longer periods. It's been negative in individual years, but I've never seen an extended time period, 5 or 10 years, where earnings growth has been negative. It's been positive for every decade in the last century. No analysts that I know of are predicting a zero growth rate in earnings growth. So clearly, it's not zero earnings growth. You're saying, what about assuming return on equity is equal to the cost of equity? Well, we have a problem. The return equity, if you look at the last decade, was about 17% in the S&P 500, well above the cost of equity. In fact, even in 2009, one of the worst years, or 2008, one of the worst years for US stocks, the return equity collectively for the S&P 500 exceeded the cost of equity. Put simply, the earnings to price ratio makes assumptions about earnings growth and excess returns that are unsustainable. And as a consequence, by ignoring those, it ends up understating the expected return or cost of equity. Which brings me to my extension of the earnings to price approach. Remember what the earnings to price approach misses? Growth and excess returns, right? So my implied ERP approach is an extension of what the earnings to price approach started off doing but gave up on very quickly. It basically expands the approach to bring in reality, which is earnings will grow, companies will have to reinvest to deliver that growth, and what you will get as investors is the expected cash flows left over after that reinvestment. So if I could give you the level of the index today and we could estimate the expected cash flows in the index, you can solve for a rate of return that investors will earn based on what they paid in those expected. It's an IRR. You subtract out the risk-free rate, you have an implied equity risk premium, implied in the market. It is essentially the earnings to price approach with the reality of growth and reinvestment brought in. Just to give you a sense of, and you've seen me do this on prior sessions, at the start of August 2023, the index was at 4,588.96. First thing I did was I said, look, I can't just focus on dividends because US stocks increasingly return cash in the form of buybacks. So you notice that my cash flows include dividends and buybacks. For growth, I actually used analyst estimates of earnings for 2023, 2024, and 25. And now you're partly saying two things. One is that analysts are biased, but the analysts that I'm using are top-down analysts who track aggregate earnings for the S&P 500. They're not biased. They're wrong, but they're not biased. And then after 2025, I dropped the growth rate down to 3.97%. You're saying, why 3.97%? That's my risk-free rate. And in steady state, I'm assuming earnings growth is going to converge on that number. I know we can debate the earnings numbers and the growth rate numbers, but these estimates, they could be wrong. But guess what? Assuming 0 as your growth rate, as the earnings to price approach does, is much worse. I get predicted cash flows, dividends and buybacks in the future from the growth. Incidentally, over time, I adjust the cash payout to reflect the fact that to get a growth rate of 3.97% with a return equity of 17%, I can afford to pay out only 76.7%. And payout here includes both dividends and buybacks. So I've got essentially the real world version of that generic equation. There's what you pay. There are your expected cash flows. I solve for R. Solve is too strong a word. I use the solver function in Excel because it's trial and error. I end up with a number, 8.41%. You're saying, what does that tell me? It's not what I think about the equity risk premium. You think this is what the market's judgment on the equity risk premium is, because it's based on what markets are paying for stocks and what they're expecting in future cash flows. You subtract out the T-bond rate, the implied equity risk premium, start of August 2023 is 4.44%. Now, incidentally, if you want to reconcile my estimate with the earnings to price base, remember that was very low. Just put in a growth rate of 0% and a cash payout of 100% in that equation. And guess what? The equity risk premium you get will converge on the 0.41% that you'd have got with the earnings yield approach at the start of August 2023. Bringing in growth and excess returns is what gives me my higher excess returns. I know that my approach requires assumptions about growth and reinvestment, but not assuming something doesn't mean you're not making an assumption. Assuming that growth is 0 and excess returns are 0 is an assumption as well. The question you could ask is, which is the more defensible one? And I think my assumptions, even though they have mistakes, are more defensible. So you're saying, well, which approach should I use? This graph I've shown you, I have 3 different approaches all on the same page. I have the historical equity risk premium through time. That's a blue number. The implied equity risk premium, notice it's more volatile than the historical premium. And then there's the earnings to price approach, which is negative for that extended period. First, notice the historical risk premium is stable. That's what people like about it. But it's a false stability. Markets are volatile. Things change. But if you take the implied premium, the earnings to price approach, I have to concede that the two move together a lot of the time. So if you're using the earnings to price ratio, not so much as a way of computing equity risk premium, as a way of thinking about markets, all the more power to you. But remember, I need equity risk premiums to use in my valuation. And the problem with the earnings to price approach are the negative equity risk premiums that it generates for extended periods. So based on that, I would stick with the implied equity risk premium. But this is the ultimate test, which is ultimately, and if you have a good measure of the equity risk premium, you know what it should do? It should predict what will happen to stocks in the future. So what I've done here is taken my 3 measures of the equity risk premium. The earnings to price based approach, the implied equity risk premium, the historical equity risk premium, and looked at the correlation with returns next year, returns over the next 5 years, returns over the next 10 years. Earnings price minus T-bond rate does a terrible job forecasting. Historical equity risk premiums are in the wrong direction. When they're high, expected returns on stocks are actually low in future years. Now, do you see my rationale for using the implied equity risk premium, at least in the context of what I do, which is as an equity risk premium and valuation? It yields positive numbers and it does a pretty good job of forecasting returns in the future. But there's a caveat. I don't use my implied equity risk premiums to time markets, and there's a reason why. Remember that regression I showed you of earnings to price ratios at the start of the period with returns in the subsequent period? I ran a similar regression where I looked at the implied ERP at the start of the period and returns on stocks in the subsequent 10 years. The T statistic, impressive, just like with the earnings to price ratio. But look at that scatter plot. Look at how the points are all over. There is a regression line, but look at the range around the line. I don't feel enough confidence in my predictions to make a market timing judgment. That might just reflect the fact that I don't have the stomach for market timing. But I do think that equity risk premiums are useful in valuation, but in market timing, I'm not sure that they can be used to do much more than talk about whether markets are high or low. So here are my concluding thoughts. I know that given the different approach and the different numbers, you're probably saying there's no such thing as an equity risk premium. That is not true. There is a true equity risk premium. The fact that you can't observe the truth doesn't mean it doesn't exist. There is a true equity risk premium. It's not observable. We all try to estimate it, but it exists. And our job is to try to get as close as we can to that true premium, which effectively means that not all estimation approaches are created equal. You want to pick an estimation approach, and it's a pragmatic reason that does a pretty good job of getting you closer to that true equity risk premium. That's why I focused on correlation with the actual returns in subsequent periods. And in doing this, you need to know what your end game is. My end game is to get an equity risk premium that I can use in valuation. If your end game is to time markets, then you need a lot more power than what I'm getting in my regressions. And maybe you can find it by bringing in other indicators, but this alone is not going to do it for you. So if you're a market timer, be careful. Now, I know that you'll be presented these great looking R-squares and correlations, but remember, past is not prologue. Things change. As market and economic structures change, those predictions might not make you money. And even if you buy into that historical data, remember, converting correlations and R-squareds to actual returns in a portfolio requires that you make actionable statements about what this means in terms of when you buy, how much you buy, when you sell, how much you sell. And I'm not sure that you can get there and deliver the results at the end, even with great looking statistics. I hope you found this session useful, and I thank you very much for listening.